Is CrowdStrike a buy or a sell? Let's get started with the model. This is a large cap company, 85 billion market cap. They're trading at $3.46 a share, and they have 246 million shares outstanding. This company is a provider of cybersecurity. It mainly sells subscriptions to its Falcon platform and other cloud modules. The company was incorporated in 2011, headquartered in Austin, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow grows a lot each year, from 440 million to nearly 700 million to over 900 million to 1.1 billion. Great margins. They convert 29 or 30% of their revenue into free cash flow. Net income is a profit or loss on the income statement. It's revenue minus expenses. That was negative in 22 and 23, positive in 24, up 42% to 127 million in the trailing 12 months. Really low margins, 3%, but this will grow as time goes on. Revenue is a sales for the company, and that doubled from 1.5 billion to 3.1 billion, then grew another 22% on top of that to 3.7 billion in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 68 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $58 billion. We divide that by 246 million shares. And we get a calculated stock price of $236. They're trading at $346, so they're trading at a 46% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 140 companies in the same industry as Crowd, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend that much in CapEx, 211 million. Software companies usually don't spend much in CapEx. Microsoft is an exception because they're not just a software company, they make things like computers. A good debt to equity ratio, 0.3. That means for every dollar of equity, only 30 cents of debt. They don't pay a dividend. Most companies do not pay a dividend in this industry. They generate a lot of free cash flow, 1.1 billion, about double the median. They rank 5th in market cap, well behind Microsoft, also pretty far behind Oracle and Adobe. All their price multiples are a lot worse than the median, so they do seem overvalued according to this. Their revenue is 3.7 billion, a bit higher than the median, a lot lower than the average, but they're growing like gangbusters, 25%. That's their 5-year annual revenue growth rate. Cloudflare is growing the most at 43%. The stock did come down a lot when they had that big crash, the server crash. The 52-week low is 210, the 52-week high is 392. But the stock is getting back up there. It's getting close to the 52-week high. If you put $10,000 into this company when they started trading, you'd have $60,000 today, a 39% annual return. To summarize, I have them trading at a 46% premium, ranking 7 out of 10. I do like this company a lot. Short term, it looks a little overvalued, so I wouldn't buy it probably. I give it 6 out of 10. Long term, definitely would buy it, 9 out of 10. Ratios are real weak, 1 out of 10. Financials are solid, 9 out of 10. Free cash flow up 150% since 2022. Revenue up 158% since 2022. Let's look at their most recent 10Q. This is the 3 months ending 10/31/2024, the 3 months ending 10/31/2023. They had their first quarter with 1 billion of revenue. Last year was under 800 million. Subscriptions is their bread and butter, 960 million. Professional services, 47 million. Professional services is down, which is fine because subs are up a lot. Let's see if they give a different breakdown of the revenue. Of the 1 billion of revenue, 680 million is in the US, 68% of their revenue. EMEA, 160 million. APAC, 100 million. And other countries, 63 million. Their revenue went up in each country. US went up the most. It went up 150 million from 10/31/2023 to 10/31/2024. Let's go back to the income statement. Below revenue is cost of revenue, 255 million. In order to generate the 960 million of subscription revenue, it cost them 216 million. Really good margins. Professional services revenue, 47 million. It cost them 39 million. Not good margins. Revenue minus cost of revenue gives you your gross profit, 755 million, up from 590 million. Selling and marketing, 408 million. That's up a lot. R&D, 275 million. G&A, 126 million. Total operating expenses, 811 million, up from 588 million. So they have an operating loss of 55 million. Last year, they had less revenue, but they had a gain of $3.2 million. So for the quarter, they have a net loss of $17 million. Last year, they had a net gain of $27 million. And they increased their shares outstanding, 239 million last year, and now 246 million. So they lost money and they're diluting shareholders. Let's look at a balance sheet. Current assets, $5.6 billion. Current liabilities, $3 billion. So a really good current ratio. Total assets, $7.8 billion. Their biggest asset is cash, $4.3 billion of cash. They have a lot of cash. Property and equipment, $746 million. Here's a breakdown of the $746 million. $700 million data centers, $250 million capitalized internal use software, leasehold improvements, $42 million, construction in progress, $210 million. So the gross value of their PP&E is $1.2 billion. They depreciated $474 million. That's how you get the $747 million. Their total liability is $4.7 billion. They have a lot of deferred revenue. This means they receive payment for their service, but they haven't provided the service yet. They will provide it over the next several months. They have another $800 million of deferred revenue. This is in a non-current section. So this is revenue they'll recognize beyond 12 months. Here's their deferred revenue by country. $680 million in US. Their revenue for the quarter was a little over $1 billion. Deferred revenue was higher, it was $1.1 billion. So they received $2 billion of cash for the service they provide, but only booked $1 billion. They will book the other $1.1 billion over the next 12 months. Let's go back to the balance sheet. Assets minus liabilities equals equity, $3.1 billion of equity. They raised $4 billion from selling their business. They lost $1 billion from running their business. That's why they have so much cash on their balance sheet. They raised so much equity. Here's their income statement. So for the trailing 9 months, they had net income of $76.1 million. That's their accounting profit for the last 9 months. Remember this number because on the statement of cash flows, it starts out with $76.1 million. Because in order to calculate operating cash flow, you start with your net income and then you adjust for the non-cash items on the income statement. So they actually received $1 billion of cash from running their day-to-day business, even though they reported a profit of $76 million. In their investing section, they spent $167 million on PP&E, property, plant, and equipment. They spent $96 million on acquisitions. Let's see who they acquired. Just last month, they acquired Adaptive Shield. That's a SaaS-based cybersecurity company. And they spent $213.8 million in cash. And it looks like they acquired this company for $213.8 million in cash. Let's go back to the statement of cash flows. In their financing section, they received $56 million from employees buying stock. So the cash at the beginning of the accounting period, the cash on 1/1/2024 was $3.4 billion. Over the next 9 months, they received $1 billion of cash from their operational business. They spent $200 million of cash from their investing business. They received $61 million of cash from their financing business. So the cash at the end of the accounting period on 10/31/2024 was $4.26 billion. Remember this number because you'll see it on the balance sheet. It's right here, $4.26 billion. That's how the statement of cash flows and balance sheet are connected. Let's look at Simply Wall Street. Its price is $346, 85 billion market cap, down 7% in the past week, up 47% in the past year. It looks like the stock IPO'd in 2019 at 68. In October 2021, it peaked at 285, and then it really struggled for a while, falling below 100. But it kept climbing over the next several months, passing its all-time high, almost getting to $400 a share. And then they had that big fiasco, and the stock crashed. It fell to 222, but it's been creeping back up there, now around 350. Simply Wall Street's valuation is 334. They say the stock is 3% overvalued. 45 analysts priced this stock at 370. They say it's a little undervalued. 30 analysts project their free cash flow for 2026 to be $1.4 billion. 21 analysts predict $1.8 billion for 2027. Look how low their revenue was in 2017, $52 million. Their revenue 10x'd over the next few years, almost hitting $500 million. Look how much their revenue grows. It never goes down. It just keeps going up, hitting $3.7 billion currently. It almost seems like they're cooking the books. It just perfectly goes up in a nice straight line. They were debt-free up through 2020. Then they added $700 million of debt, and they're still at $700 million. But their equity is so much higher than their debt. Equity $3 billion. Debt, $700 million. And this looks odd, but they have more cash than equity. But of course, that is possible. The CEO's salary went from $400,000 to $950,000. Total compensation, $47 million. Tenure as CEO, 13 years. In the past year, everybody and their mother is selling this stock. Nobody buying it. Look at those insider sells. That doesn't give you too much hope for the company. About 450,000 insider shares were sold in the past 12 months. 72% of the company is owned by institutions, 24% by the general public, and 4% by insiders. Their biggest shareholder is Vanguard, then BlackRock. The CEO owns 3% of the company. Bank of Montreal, First Trust, T. Rowe Price, Invesco, JP Morgan. Their employee count in 2018 was under 1,000. Now it's almost 10,000. And the ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Borsa Italiana, Lima Bolsa, Sao Paulo Bolsa, and the NEO. So if you want to learn how to build a discounted cash flow model in Excel and value a stock so you know whether it's a buy or a sell, click on the video in the top right corner. I also send you a free copy if you're nice to me.